Hello, this is Nate Williams from Practice Financial Group, and I am hosting a webinar titled PFG Investment Portfolios. In this webinar, we're going to be talking about the investment portfolios that we've built, and we're going to take a deep dive into how they're designed and what has happened in the last couple of years, the last year especially, and even in the last 10 years. So, just to get started, we've got a chat box over here on the right-hand side of your screen. And so if you're here, go ahead and just say something in the chat box, just so I know that you guys can hear this and everything's working okay. Great. Okay. Video's okay and audio's okay? Great. All right. Well, it's nice to see a bunch of familiar names in the chat box. I'm just going to act like this is a conversation among friends, and which is how I feel. So one of the things that I'd like to do also is, rather than have the chat box blow up with a bunch of random comments, not that they're not all great, if you could reserve the chat box for questions you have, that's I think that is going to be the best option. And so I'm going to take the next 30 minutes or so to just share the content that I have prepared. And then after that 30 minutes is up, I'm going to open it up for question and answer. And then I will turn my attention to the chat box, which is where those questions will be. So to get started, I'm going to go ahead and share my screen, and you should now be able to see the screen titled PFG Investment Portfolios. Can everybody see that? Give me some kind of feedback in the chat box if you can. Okay, great. So before I get started into this prepared content, I've got a couple of things that I've been pondering that I want to share. The first one is, we're in the season of Thanksgiving, and one of the things that I want to share that I'm grateful for is the miracle of modern investing. I'm a student of history, and one of the books that I've personally really enjoyed was a history book about the prophet Joseph Smith, the founder of the Church of Jesus Christ of Latter-day Saints. And in that book, his mother tells an interesting story about an investment her husband made. And this was in the late 1700s. He had earned some money from farming, and he wanted to invest his money. And so he went to a shipping boat captain who was involved in the spice trade. And this individual with his crew would travel by boat from America to India, buy spices, and they would come back and they would sell the spices in the Americas at a profit. And so he gave them his investment, and they went out on their ship. And they never heard from the captain or the crew or the boat again. There was no notice. There was no, as far as they knew, the ship could have sunk. They could have been attacked by pirates, or they could have just taken the money and just stolen it. That was investing in the 1700s. So our opportunity to invest today is no less miraculous than is modern communication or modern medicine or transportation. It's really a miracle, the ease and the availability of investing to us. The second point that I want to make is, sometimes when we think about investing, a lot of people think that you put your money in this account, you cross your fingers and you hope that it grows. And I hear people all the time say that I want to invest in something tangible, something that I can kick, because as far as I know, this is just a number on a screen. And I know the way that it's presented to us is as a number on a screen, but what investing really is providing capital to real companies. It's important not to forget that. One of the best books that I've read in a long time was a book called Shoe Dog. Shoe Dog was written written by Phil Knight or ghostwritten by somebody, but the content was authored by Phil Knight, the founder of Nike. And in that book, and I would recommend it to anybody who loves a really good read and is interested in business, in that book, he tells the gory details of the founding of Nike. And as you read the book, and I'm not going to get into it, but as you read the book, you see, and he tells the whole story of bringing the company public, the initial public offering, when they're finally able to access capital from capital markets, from investors, and how that was really the turning point that really infused the company with the capital that it needed to grow and to become what it is today. And so by investing, not only are we getting a return, and that's what's in it for us, but we're providing the lifeblood to the global economy so that entrepreneurs and business owners can take their ideas and turn them into reality. So that's another point that I wanted to make before I get into the prepared slides. The last point that I want to make, and I think this is really, really important. Any investor needs to understand this. And I think it will be easy for you to understand, but it's very, very misunderstood, this concept that I'm about to teach. That is this: the moment you purchase an asset, the purchase price for that asset becomes a sunk cost. You can't go back in time and undo the fact that you purchased an asset. Take your home, for example. Once you decide to buy a home and you sign on the dotted line, you pay the money, the down payment, you get the loan, you can no longer go back in time and undo what you did. The only thing that you can do at this point in time is decide to continue to own the asset or to sell the asset at today's market price. That's really important. So many investors make poor decisions based on the historical cost of what they paid for an asset. For example, if you bought shares of Apple stock this year, you're paying top dollar for that. Next year, it might go down. And you might think, dang it, I paid too high and it's gone down 20%. Now I should sell. Well, what you need to understand as an investor is the price that you paid for it is completely irrelevant at this point in time. Let that sink in for a minute. The price you paid, the historical cost you paid for an asset is totally irrelevant to the decision of whether or not you should continue to own or should continue to sell the asset today. Now, why is that so important? Everybody gets really upset when they pay this price and the asset price declines. Everybody gets upset by that. And I don't disagree with that sentiment. Even I get upset by it. All of us would like to buy assets and have them go up and only up. But that's not always the case. The market doesn't work like that. The market's constantly repricing. Now, what we need to understand is that when we purchase an asset yesterday and it goes down today, now we're all upset and we're feeling like we made a bad decision. We may have made a bad decision, but the decision we made yesterday is irrelevant. The only thing that's relevant is the decision to buy or sell it today. And here's the thing that you need to know, and you need to understand. It's probably something you already do know. If the price of the asset that we bought yesterday goes up, the risk in owning that asset has also gone up. The other thing that has gone up is, or the risk has gone up. The other thing is that the future expected return has gone down today as opposed to yesterday. So when you invest in an asset and it goes up and you're excited and you're feeling good about it, you need to understand that those good feelings really what you've done is it's like It's like being in an elevator and going up. The risk of falling has gone up, but also the future expected return has gone down. On the contrary, when you buy an asset and when the price subsequently goes down, what has happened is the risk in owning that asset has also gone down. And the future expected return of owning that asset has gone up from that point in time today. So again, remember, the price you paid is irrelevant. When the asset price goes down, everybody gets upset, but that getting upset is, you shouldn't feel that way, because your decision to buy or the decision today is, should I continue to own or should I sell this asset today at a lower price? But if you decide to sell when it's low, just know that you're selling that asset at a lesser position of risk and a higher position of expected return. So those are some really important concepts to understand. Those weren't in my slides, but I thought to throw those in there at the end. Again, first of all, the miracle of modern investing. Second of all, investing is how companies get capital to grow. It's not just some hocus pocus. And the third thing is, when you buy an asset, the historical cost is totally irrelevant. What is relevant is, should you continue to own that asset today, or should you sell it today at the current trading price? And if the price goes down from when you bought it, remember that the new position of ownership or sale is at a position of lower risk and higher expected return. So with that, we're going to continue. This slide shows asset class investing versus the S&P 500. And what I'm comparing right here for everybody to see is how the PFG 100% equity portfolio has performed against the S&P 500 during the last 1 year, during the last 3, 10 years, and 20 years. Now, why am I doing this? Because in the last year, our investment portfolios have significantly underperformed the S&P 500. And that has caught a lot of attention. It's caught our attention. Nobody's paying close attention to this than we are. And I want to talk about that. Why against the S&P 500? Now, the S&P 500 is, in our investment portfolio, part of what you own are the S&P 500 stocks. In fact, the largest holdings in our portfolio are Apple and Google and Amazon and Facebook, all of these big S&P 500 companies. The reason why this comparison against the S&P is so important is because we're Americans, we live in America. All of the news that we hear, all of the financial news that we hear is the S&P 500 or the Dow. What is happening in the large US indices? And so we're constantly compared against that. Everyone constantly compares against that. And it's because we live in the US. So what the substance about this, the rest of this conversation is going to be, is we're going to dissect and we're going to figure out why in the last year has our portfolios underperformed the S&P by almost 20%. In the last 20 years, our portfolio is up by over 1%. But in the last 1 year, it's down. And why is that? The first reason is that we invest internationally. Our portfolio is about 60% US-based stocks or US-based companies, and 40% international-based companies. So for the past 10 years, we've been heavily tilted towards the US, but we still have 40% allocation to international. In the last 10 years, from 2010 to 2019, the US has been the #1 highest returning country by the country's index. So each country that has stocks in that country. Each country has its own index, its own S&P 500, as you will. And in the last 10 years, US has been number one. Greece, last place. So if you have an investment portfolio that's invested at all internationally, that international exposure is going to drag on your investment returns from 2010 to 2019, as you can see. Interestingly, if we go back a decade and we look at 2000 to 2009, the US was one of the worst. So in the last decade, we've been number one. In the decade before, we were almost in last place. Only Japan, Greece, Finland, and Ireland underperformed the US in that decade. If we look at the 20-year history combined, the US is somewhere about right in the middle, a little even lagging behind the middle. So Colombia would have been the place to invest in the last 20 years. So this is just data. Interestingly, this slide shows it shows a bunch of different countries, the year and who was the top performing country in that particular year. And as you can see, in the last 20 years, the US has only been number one time, and that was in 2014. The US market had a 12.7% return, and that was enough to get us the gold medal that year. So in any given year, you never know where around the globe the returns are going to come from. And also, Americans aren't the only people in the world who are developing and who have good ideas. And America isn't the only place in the world where entrepreneurs are born. There are many entrepreneurs and many smart people and a lot of growth and development that happens outside of the US, surprisingly enough, you know. Joke on that last comment. So anyways, that's reason number one. We've been investing internationally. I'm going to change to another topic to talk about value investing. You'll hear these terms in investing, growth and value. Of what is a value stock? A value stock is a stock that has a low price to book ratio relative to a growth stock that has a high price to book ratio. So price to book is the formula for price to book. That's a term you'll hear as you dig into investing. It's the total market capitalization of a company. The total market cap is the total number of shares of that company times the price per share. So if a company had a million shares and the shares were trading at $1 a share, the total market cap of that company would be $1 million. And so the price to book is the total market cap, the cost of all of the shares outstanding divided by the book value of the company. Now, book value is simply the equity of the company, which is the assets minus the liabilities. It's also known as intrinsic value. So these terms are all synonymous: book value, equity, or intrinsic value. And so if you step back and think, okay, well, what is a value stock? It's a stock where the price you have to pay to own that stock is low relative to the assets of the company, or excuse me, relative to the equity of the company. Now, when you're the owner of a company, what you really own is the equity of the company, or you own the assets of the company as the owner. But then, of course, you owe all of the liabilities. So what is really yours, your book value or your intrinsic value or your equity, is the assets minus the liabilities. So when you're buying a share of stock, what you're really buying is just your share of the equity of the company. That's what you get. And so a value stock it's just a good value. You can think of it as a good value. You're paying a low price for the amount of equity of the company that you're buying. So here's an example of a value stock. So the book value of the company is $1 million, let's just say. The assets minus the liability, or the equity, is $1 million. The total shares outstanding for this company is 1 million. And so the book value per share is $1. So if you have to pay $1 for a share, then the price to book is $1. So a value company, and if you have to pay $3.50 per share or per $1 of book value, then the price to book would be $3.50. So the same company, if you have to pay $1 per share versus $3.50 a share, this would be considered a value company where the cost per the share price per the share or per book value is low relative to this one right here, where the share price relative to the equity of the company is high. Let me give you a real life example. I remember, seems like a couple of years ago, I don't remember the date, but I remember the BP oil spill, British Petroleum, big company, global company, really valuable, has a ton of that equity on the books. And one day they had this oil spill. It was all over the global news. Everybody knew about it. Everybody was talking about it. Immediately, the price of the company declined because of all of the bad news, the bad press. People were boycotting BP. The assets of that company hadn't changed 1 cent. They still had all of the assets, and they still had owed all of the liabilities, and therefore the equity of the company didn't change 1 cent from the day before the oil spill to the day after the oil spill. But because of the decline in the share price, the price per book became much lower. That company overnight went from a growth company to a value company. So value investing is basically what we're doing is we're trying to find companies that are on sale where we're getting good equity, good value for the price that you pay for them. This is kind of interesting. Some of you may have heard of this book, The Intelligent Investor. The Intelligent Investor, if you look at what are the top 10 investing books of all time, The Intelligent Investor is going to be on everybody's list. And this is the definitive book on value investing. And what Benjamin Graham tries to teach is how to value companies and relative to their stock price. Look at who gives this book praise. By far the best book on investing ever written. Now, Benjamin Graham, the interesting thing is, who is much more well-known than Benjamin Graham is Warren Buffett. Warren Buffett has literally based his entire investing strategy, his entire life's work on value investing. In fact, Benjamin Graham was one of Warren Buffett's college professors and one of his mentors. And so this idea of value investing isn't new. Here's a little bit more about value investing. And I'm also going to bring in another type of investing, which is looking at a company's size. And the company's size is very intuitive. It's very easy to understand, easier to understand than value versus growth. Company size is just simply a small company versus a large company. PFG, very small company. Charles Schwab, very large company, right? Your dental practice, very small company. Aspen Dental, much larger company, right? So small versus large is simply comparing the size of the company. And so when you're looking at investing, if you can look at the market as a whole, but you can also slice up the market and look at different characteristics of stocks, and we can analyze those characteristics over a large period of time and see how those characteristics perform under different market circumstances. And this just shows some really interesting data from 1928 to 2019. So over this 91-year period of time, everybody would say that the US market has returned 10% per year, right? Everybody would nod their head, yeah, 10% per year is what you get in the market. Okay, well, part of the market that's true. If you look at large companies, so the large index like the Dow or the S&P 500, those large companies over the last 91 years or more have returned on average about 10% per year. Now, mind you, that is not in nice, equally packaged 10% increments. But over the same time period, small companies have earned on average 11.49% per year, almost 12% per year. And so there's this 2% premium if you're to invest in small companies versus large companies, okay? Value is even more interesting. Over the same time period, if we divide the market up between growth companies and value, forget large and small, just growth and value, growth companies have earned 9.36% per year. Value have earned 12.54%. for a premium difference of 3.18% over this long period of time. These things are kind of intuitive. Value companies are higher risk companies. Like BP, with its oil spill, there was risk that BP was going to go out of business at that point in time. There was risk that nobody would ever buy their product again, and they would have to sell off their company in parts, and all of the investors would lose all their money. That was a possibility. But also, with the declining price, the future expected return goes up. So with value, there's higher expected return, but also higher risk. Small, same thing as well. In the time of a recession, it's the small companies we have to worry about whether or not they'll survive the recession. The large, the big, massive, mega companies, we don't have to worry about those. Small companies you have to worry about. And so over here on the right, we've kind of put up this chart. This is very simplified, but the concepts are important to understand. Up here in this upper right-hand corner, we've got on the top axis, or the x-axis, we've got value and growth. And over to the right side of this spectrum, we've got growth companies. And on the y-axis, we've got large at the top and small at the bottom. So in this lower left-hand corner, you've got small value. And over here in the right, you've got large growth. And down here with the small value, this is where we have the highest expected return. It's also the highest risk, right? Meaning volatility. Up here in the upper right, we've got the highest, we've got the lowest expected return. We also have the lowest risk up here. So So when we're designing a portfolio, we can manipulate the risk and return components, or expected risk and expected return components of a portfolio. We can manipulate those by tilting a portfolio more towards large growth or more towards small value. So moving on, and I'm going to take a pause for a minute. I'm not going to stop to answer questions right now, but as questions arise, please put them in the chat box. And then I'll go through and answer all of those questions at the end. So if I'm saying something, drop the question in the chat box and we'll come back to it. So this is kind of a visual representation of what we're talking about. When we're talking about small value and higher expected return, what we're not saying is that these are better companies. What we're saying is that from an investment perspective, there's a higher expected return. That's an important distinction. Look at these two houses. Which one of these houses is a better house? Which one is better built? Which one is going to last a hurricane better? Which one is going to last longer? Perhaps, which one would you rather live in? And everybody would agree that this house right here is probably the better house. But which one is the better investment? And from an investor's perspective, it's not just the quality that you care about, it's the quality relative to the price that you have to pay for that quality. And so I would agree that this is a better house, but is it a better investment? It's very likely that this little shanty over here is a better investment to make, and you'll get a higher return on your investment with this little house over here than you will in this big one over here. So there's this spectrum, right? Value and small is down here where you've got a higher expected return, also higher risk, and growth up here where you've got a lower expected return up here. So if the total market is right here in the middle, the S&P 500 with the 500 largest companies by market cap, the S&P 500 is tilted way over here on the growth spectrum, much lower expected long-term return. And we saw that right here with this slide where we compared the large companies and the growth companies versus the small in value. Interestingly, right now, as these companies are priced, the FANG stocks, FANG is a term, stands for Facebook, Apple, Amazon, Netflix, and Google. With the price that you have to pay to own these shares today, these are way, way over here on the far end of the spectrum of growth. They're the growthest of the growth companies, if that's even a term. And so if you go and buy shares of those companies today, yes, you might be buying shares of the best companies. I'm not going to debate that point, but you're also buying shares of the companies with the lowest expected return of any company in the whole market. So that's kind of an intro or a piece on value and growth investing. I want to talk about a phenomenon. This isn't a strategy. It's just an observable phenomenon, kind of like something you observe in nature. And it's this phenomenon that we call in the investing world called flight to quality. What flight to quality means is that when there is widespread fear, money moves to safer or higher quality assets. That's what flight to quality means. And we see this flight to quality or flight to safety. We see this in other areas of life as well. Right now, my 3-year-old daughter comes into our room at night, probably 1 out of every 2 or 3 nights. She has a nightmare, has a bad dream or something, gets scared and comes into our room. It seems like it's every 2 to 3 nights that she comes in and does that. And that's just her being scared, feeling fear, and wanting to go to a safe place, mom and dad's room. So this is a chart starting. This is interesting. These are stock versus bond returns from February 1st through April 30th in the US. Now, we can all remember this is when the coronavirus started hitting the news and starting to be a big thing. And this is the returns of the S&P 500. So during this time of flight to quality, everything going along just fine, market climbing. All of a sudden, the news of the coronavirus hits, everybody gets scared, and the market starts to drop and it starts to fall. Likewise, returns on bonds start to skyrocket during this time. Now, this doesn't make any sense at all. There's no rationality to this right here. The thing that you would expect to drive up bond prices would be higher interest rates. During this time, interest rates were also falling. The Fed was cutting rates even further, and interest rates are at an all-time low, right? And so you would expect, as interest rates decline, if people were rational and if the market were rational, you would expect that interest rates would fall. But bonds are a perceived safer or higher quality asset. So we see during this time of fear, we see this spike in stock price or a spike in bond price. Well, what happened with the rest of the market? Let me show you something interesting. In the last 1 year, from September 30th, or ending September 30th, 2020, in the last year, the returns on small companies relative to large, there's been a 15% spread. In the last 1 year, small cap stocks have returned 2.8%. large cap have returned 17.86%. And these are perceived as higher quality assets. And so money is flowing into here and away from the small, which are perceived as lower quality assets. If we look down here at value, the spread is even much larger. In the last 12 months, growth stocks, ignoring size, just looking at growth stocks have returned 33.56% in the last year, whereas value stocks have lost 15.51% for a spread of 49.07% in the last 1 year alone. So here's this graphically. Here's that same time period of fear when the market started declining. News of the coronavirus, everything falls at first. Bond prices shoot up. And then investors realize, wait a minute, the government's printing all this money. There's going to be inflation, and so we need to get back into equities. Money starts pouring back into equities, but it overwhelmingly starts pouring into large growth, the companies that are perceived as higher quality and safer investments, and money is going back into value a little bit, but not nearly as much. And it is going back into small, and you can see that the returns for small are still positive. Value, the returns are still negative from a year ago today, or a year ago as of September 30th. But money isn't flowing into those assets nearly as much as it's flowing into large growth. So yes, a year ago today, if we would have known that the coronavirus pandemic was going to happen exactly as it's happened, and if we would have known that large growth would have returned 33% versus small in value, yes, we would have moved all of our portfolio there. But at that point in time, we didn't know that. Any more than today, at this moment in time, we don't know what the future is going to hold for these asset classes. So just to sum it all up, and this is now really highlighting value, starting July 1926, starting on that date, for the next 84 years, if you would have been investing in value for 84 years, your return would have been 12.8% per year. Not in equal 12.8% increments, but overall 12.8%. Whereas if you would have been investing in growth, it would have been 9%. That's through June 2010. During the next 7 years, from July 2010 through June 2017, the returns would have been 14% for value, 16% for growth. And then in the subsequent 3 years, from July 2017 through June 2020, you would have lost 3.3% per year investing in value and gained 17.9% investing in growth over that period of time. So, and that, of course, is accentuated by what's happened in the last 12 months. So if we go back to the very first slide that I showed, what's happened in the last year? Our portfolios do tilt towards small and value, and there is international exposure. And even international, we tilt towards international small and international value in order to capture these premiums that we expect to be there over the long term, right? Everyone who's listening is a very long-term investor. Even if you're the oldest person on the call, if you're 65 years old, you still have to plan to live possibly another 30 or more years. So you're still a long-term investor. And the reason for these declines is this flight to quality that we've seen, where money has flowed out of lower perceived quality assets and into higher perceived quality assets. And what's happened in the last year has really accentuated returns even over the last 10 years. Is this the first time this has happened? And is this the only time that this has happened? Absolutely not. This chart shows This shows the market. So this is stocks versus bonds right here. This is small cap. So this is small companies versus large. And here's value, value stocks versus growth. And each one of these bars, and this is just historic data, each one of these bars shows, that, sorry, I lost my train of thought. Each one of these bars represents the 10-year period of time ending that year. So this starts in 1937. This is the 10-year ending period ending 1937. Whereas if you would have been invested in the market, you would have lost by 2.65% compared to bonds for that 10-year period of time. So each one of these each time you see a blue bar, this is the market versus, this is stocks versus bonds. Each time you see a blue bar, you'll see that the 10-year ending with that year, the market has outperformed bonds by that amount, that data. So here's a data point in 1955, the 10-year ending period ending 1955, you would have been better off investing in the market versus bonds by 13.7% per year. And so these red lines are times when either the market, just stocks versus bonds, or small versus large, or value versus growth. The red bars show 10-year ending periods ending where that premium, or that dimension of return, as we call it, has underperformed the others. So this so small versus large, you would have been much better off investing in small versus large over the past 91 years. But during the 90s and into 2000s, here, this is 10 years of period of time where small underperformed large, but this was a 10-year period of time. So by the year 2000, or by the year 1999, small had underperformed large for 20 years in a row. Not every year, but just the 20-year ending period, 2000, small had still underperformed large. This is kind of interesting, just going back and sharing historical data. We call this a skittle chart. Each one of these different colors represents a different asset class. So this red one is small growth companies, this bright red. The dark green is commodities. And it shows every year which asset class was the highest performing. So in 1998, large growth was the highest performing asset class. Commodities were the lowest performing asset class. In 1999, it was emerging markets was the highest performing, with a 66.5% return from that 1 year alone in 1999. The next year, emerging markets was the least performing at negative 30%. So as you can see, on a year-by-year basis, returns look very random. But the theory, if we go back here, the theory is that as we tilt a portfolio towards small and value, we would expect a higher return because there's more risk and there's a higher expected return there. If I sort these asset classes based not on 1 year returns, but 30-year compound returns, you can see that returns are much less random. And you can see small value has been the highest, has been the winner. It's been the highest returning asset class year over year over year over year if you look at a 30-year period. And so we're always preaching this principle of patience. We're preaching this principle of focus on the long term. And people get that. They get that, okay, this needs to be a long-term thing. But then it's very, very, very difficult to actually believe that when you look and say, well, over the last year, this investing strategy that I've been investing in has gotten a negative 9.63% return, whereas everything that I hear on the news is up 10%. during those period of times, it's very difficult to remember that, oh yeah, this is a long-term thing, and I need to just be patient and wait for the long term. So clients always ask me the question, well, what does the future hold? What is next year going to look like, and the year after that, and the year after that? And that's a good question. The answer to that question is, I have no idea. I have no idea what next year is going to look like. You know, is Pfizer going to come out with a vaccine, or is somebody else going to beat them to the punch? How effective is the vaccine going to be? Will the U.S. economy be shut down again, or will it be opened up with a new vaccine, and will the engines start to roar again? And what will happen the year after that, and the year after that, and the year after that? And what will be the long-term effect of children not being in school? I don't know. I don't know the answers to those questions. Time will tell. What we do know is that never in the history of investing, never, ever, ever, as history has played out, has it made sense to abort an investment strategy because of decline of asset prices. Right here, when you get down after the market declines at this point in time, never has it made sense to jump ship then because of the decline. Remember that the price you paid is totally irrelevant right now. What I need to decide right here is, am I going to sell, or am I going to continue to hold, or am I going to buy more? And remember that as you're making that decision, when the price falls, the risk in ownership has also fallen. And future expected return has also gone up. So, so the fact that our portfolio and these segments of the portfolio have fallen in value, that is not a reason, as far as we're concerned, to abort. The other thing is, I started by talking about the miracle of modern investing. The miracle of modern investing makes it so that the common person, the common man, the common woman can be a business owner through being a stock investor. Anybody can be a business owner. And that's literally what happens when you buy stock. And throughout the history of the world, through all time, the wealthiest people in any society have been the business owners. Now, historically, those were the landowners, right? Because back in the 16th century and 15th century and 14th century and before, the only real asset was land and farming, right? And then maybe a mine for mining. And so it used to be that the wealthiest people were landlords. Well, nowadays, and I think throughout evermore, the wealthiest people in society today are the business owners. And it's been this way for hundreds of years. The wealthiest people in society are the business owners. And as a stockholder, that's what you are. And what will the future hold? I don't know, but I believe that the business owners, meaning the stockholders, will continue to be the wealthiest people in society. So those are the planned remarks that I had today. Went a little longer than I had expected, but I hope this is helpful. I'm going to open it up for anybody who wants to stick around and ask any questions. I'm going to open it up for a Q&A. And if you have a question, just type it into the chat box, and I'll stick around until the asking of questions dies out. Maybe that asking a question dying out is going to happen sooner than later. Is anyone still listening? Okay, well, I guess I'm going to look through and see if we have any questions that were asked previously. And no, we don't. And so I'll wait around for another minute, and if we get any questions in that time, I'll answer those, but if not, we'll sign off. Great question. There's a question in the chat box about buying gold. Thanks for serving up a softball to get the Q&A started. We have never recommended buying gold or any other precious metal, and we never will recommend buying gold or any other precious metal. Now, there's a real important reason for that. The reason is that we don't believe that gold has any productive value, any real intrinsic value. Now, you might disagree. You could say, well, no, it does. It trades and it, all these things. But if I buy a bar of gold and I take that bar of gold and I stick it on my shelf and I wait 30 years, 30 years from now, the bar of gold will be a bar of gold with a big pile of dust on top of it. The dust will have been literally your return on investment. And so in order to get a return, you have to find somebody else who thinks that bar of gold is cooler than you do or shinier than you think it is and are willing to pay more for it than you. Whereas if I buy a share of Apple stock, for example, and I wait 30 years, who knows what they're going to create and develop and produce during that time. So businesses are productive. Bars of gold are completely worthless from an investment perspective. Now, if there's a mining value of gold, if there's a value of gold as a material, then that might be something. I don't know what that is. And maybe crowns, dental crowns, if anybody still uses those, but that's it. So Roslyn Capital, I would not invest with them. How do I talk to my wife about buying a Lincoln Navigator as an investment? Buying a Lincoln Navigator is 100% of the purchase price will end up in the junkyard one day. So it might be a good decision. It might save your marriage, who knows, but poor investment. Another question from Caitlin. Due to the pandemic, any different advice on immediate cash savings, business or personal? Great question. So everything that I've talked about in this webinar is the long-term investment decision. What are we doing with our money for the long term? And we have never advised somebody to stick their money in the market as a short-term holding place. And we always use as a barometer 5 years at least or more. Otherwise, the money should be in cash. So great question, Caitlin. Because of the pandemic, if it were me and if I were running a dental practice, I would be holding more cash than I normally would. In Oregon, where I'm recording this from, we're on a 2-week freeze, whatever that means. Dental practices are still open, thankfully. I've heard that some of there are rumblings in the Biden administration that in January they want to shut the whole country down for 4 to 6 weeks. That could shut dental practices down. And so if I'm a dentist today, I'm preparing possibly for less traffic in my practice, more canceled appointments, and possibly another shutdown. So I'm going to keep adequate working capital on hand and an adequate emergency fund reserve. And that's the first thing we always recommend people do with their cash. So if you've been following our advice, and if our advice has been consistent, and I'm looking at our planning team on this, there shouldn't be any big major change heading into possible pandemic and shutdown time. Dallin asks, ETFs or mutual fund for small value equities? Great question. ETFs were designed to basically duplicate mutual funds and have all the components of a mutual fund, but to be traded like an equity. So I'm not going to get into the details of ETFs versus mutual funds on this webinar. I think that it's beyond the scope of this meeting, but those two assets are very interchangeable. So will this be recorded, Brett? Yes, this is going to be recorded and available on our website. Tom asks, also, as you know, I've purchased some commercial and non-commercial real estate. We've enjoyed this diversity. Would you encourage more of this over time or not? I personally have never been an advocate of investing in real estate outside of investing in your home and possibly your office. Now, even your office building, I will say the two wealthiest dentists that I've ever worked with, neither of them owned their office. And so owning your office is not a prerequisite to being wealthy. And my data points are the two, number one and number two wealthiest dentists I've ever known didn't own their office. So in our investment portfolios, we have exposure to real estate through real estate investment trusts. Also, a lot of the companies that you own also invest in real estate. The reason I don't recommend real estate as an asset class, like real estate that you own and manage, generally speaking, is if your name is Dr. fill in the blank, the value of your time is really high and your time focused on your practice is really high. The difference we see in practices and the profitability in practices is astounding. We'll see one general practice where the net operating income is $1.5 million in a year for a general dentist. We'll see another practice where the operating income is $200,000 in a year. Well, what makes up the difference? I mean, there are a lot of things, but oftentimes it's the focus, the intensity, and the skill of the doctor. So if your name is Dr. So-and-so, we always recommend that you invest your time and your energy and your focus on becoming a better doctor, becoming better at your trade, and focusing on running a better business. And then outside of that, we recommend that you focus your time on being a better wife or husband or father or mother, or your hobbies or the other things that bring you joy in life. As far as money-making ventures, we recommend you focus all of your energy and attention on your practice. And outside of that, I'm a huge believer in passive investing, which the stock market is. So that is the advice that I give. I mean, obviously, there are different personalities and different desires and different circumstances within that, but those, I think, are the general principles, and I believe those principles are very sound. Let's see. What do we say to our staff when they look at investments and question about declines? The easiest answer when assets have declined is that we own shares of the best companies in the world. And when they decline, we're literally buying more shares of those companies on sale. And if you're a net asset purchaser, meaning you're an investor, you're buying investments, you should get excited when the market goes down because you're able to buy more at a lesser price. If you're an asset purchaser, then yeah, you want the share prices to go up so you can sell at a higher price. Everybody gets this when it comes to like buying milk at the grocery store. If there's a sale on milk at the grocery store, everybody gets excited about that. But people don't understand that when it comes to investing. And so I would just try to explain that as far as if somebody's getting upset or nervous because the prices have gone down. But actually the risk has gone down, the future expected return has gone up, and now we're able to buy on sale. Can you talk about the cost demand curve with regards to dental procedures like selling crowns and dental implants? Absolutely, but that's going to be beyond the scope of this webinar. Fernando, how about investing in pharmaceutical companies developing the COVID vaccine? So great question, Fernando. I was hoping that somebody would ask this question today. My wife said to me this morning, hey, we should invest in Pfizer. The problem with doing that is you're trying to time the market and you're trying to pick the right stock. So you've got to pick the company that gets the vaccine correct, and you've got to time it in a way that that you buy the share of stock before the rest of the investing world knows that the company has developed the vaccine. So let's say that Pfizer is the first to get the vaccine, and they do it, and they are able to sell the vaccine. They make $1 trillion because of it. The time to invest in Pfizer would have been in March of 2020, not in November of 2020. But yeah, if you want to, go ahead and do it. David asked, this has been very helpful. Do you do it every year? On most years, the returns have been funner to talk about. This year, not so much. Yeah, I totally agree, David. It's much easier as let me tell you, it's much easier as an investor to stay the course and to believe in the principles of patience and long term and discipline and faith in the future, all of those core principles that make good investors. It's much easier to do that when investing is are going up. Likewise, it's significantly easier to be an investment advisor when the markets are going up. However, the truth is that it's also, I'm going to make a comparison here. It's much easier to get your kids to eat ice cream than it is to get your kids to eat broccoli. And as an investor, it's really, and as a human, it's really important to eat the broccoli, not as important to eat the ice cream. As an investment advisor, it's really, and so the comparison is, as the markets go down, that's the equivalent of eating your investment broccoli. It's not fun, nobody likes it, but as you're buying and as you're continuing to invest, your future returns are going up as the market goes down. So we call that eating our investment broccoli as the market goes down. Yeah, much more fun to talk about the up times, and it's much easier, but it's much more important to stay the course and to stay disciplined during the down times. That's actually when we make our money for the future upswings. Any other questions? Let's see. Yeah, so it doesn't look like we're getting any other questions. Just so I'll sound off. Just want you guys to know, yeah, this has been a challenging year. And we're very proud of our clients and the resilience that you've shown as you fight through this pandemic. This has not been an easy year to be an investment advisor, CPA. It has been an even more difficult year to be a dentist, and the fear that you face and being on the front lines of dealing with people and bringing your employees back. Our respect for you has gone up tremendously, and our gratitude to serve you is at an all-time high as well. Sincerely, if we can do anything to be of service to any of you, please reach out and let us know, and we'll do anything we can to help. And with that, I'll wish you all a happy Thanksgiving, and just finish with that. Thank you. Bye.